Okay. Yes. Sorry. Two. Try. Mic. One. Two. Try. One. Two. Try. Mic. One. Two. Try. Good. All right. So, so far, we've been able to cover the first four of the five activities when it comes to the process of accounting. All right. So before we went for the break, we had started dealing with reporting. And under reporting, we had started work on the statement of financial position. And we said that the statement of financial position tells of the position of the company at a point in time. So typically, for something like the statement of financial position for a company, it will be rendered as statement of financial position for, let's say, ABC Company Limited as at a certain date. As at whatever date. So it could be as at 21st April, 31st May, 31st December, whatever it is. Because it's a positional statement. It shows you your position at that time. That is your assets relative to your capital and liabilities. And their further disaggregation, as we've seen here. Before we went, we had been able to go through assets. Now, let's look at equity and liabilities. All right. When you see here, when you look here, you see under equity we have stated capital, revaluation reserve, and retained earnings. What is stated capital? Stated capital is a term of art, and it's actually defined in the Companies Act as we have it. The stated capital is the shareholders' payment or the value of their assigned shares or issued shares. So stated capital is the value of issued shares in the company. You know, when we talk about shares, there are different levels of it. So per the Companies Act, we have authorized shares, which is the total shares registered by the company with the Office of the Registrar of Companies. That's your authorized shares. And what the authorized shares basically says, this is the cap to which you can issue shares. All right? Then out of the authorized shares, the company will issue some of those shares to shareholders or members. All right? So at no point in time should your issue shares be more than your authorized shares. At best, it will be equal to your authorized shares. Are we clear on that? We are studying accounting, but we are learning something in company and commercial practice. All right? Good. So that is that. Authorized shares is the highest. Then you have issued shares, which is the value of shares issued out to shareholders. Then we have paid up shares. Paid up shares. And the paid up shares are the issued shares for which the shareholders have made payments to the company. All right? And what that suggests to you automatically then is that there will be some unpaid shares. All right? And that's why at the point of winding down of a company, especially a company limited by shares, the obligation or the liability of the shareholders is to the extent of their unpaid shares. Does it make sense? So now we have that picture clear in our minds. Authorized shares, which is the most you can issue. Issued shares, what you've actually issued out to shareholders. Paid up shares, the portion of your issued shares for which shareholders have made payment, and then unpaid shares. The maximum liability that a company or shareholders would have upon the winding down of a company limited by shares. I hope we are fine. This here, stated capital, is the value of the issued shares. Is that clear? Here in Ghana, we say, and when you look at the Companies Act, we say that the issued or the stated capital is at no par value. What that means is, it is not per the valuation of the share that we report. It is the value assigned to it. It is at no par. All right? So it is not the market value of the share. Is that clear? Great. So that's stated capital, the value of issued shares. So we then have revaluation reserve. And revaluation reserve typically, and we'll deal with the concept of depreciation and then revaluation. Revaluation reserve will typically arise from a revaluation to a thing like this and a thing like this. You know, these items typically are recorded at cost, right? So at the point where they are purchased, the cost of the item and all related costs incidental to bringing them to their useful form is capitalized as an asset, all right, at that cost. So you report it, and when we get to depreciation, you see the cost of the item, the accumulated depreciation, and then the net book value. And the net book value is what we report. However, that net book value, which is a function of accounting estimate, because you would have assumed a certain depreciation rate or useful life for the asset, and you would have depreciated it to get that net book value. That item in the market will have a certain value which probably will be different from your book value. all right? And so maybe we bought a car, a motor vehicle, for 100,000, and we said that the useful life of the car is 5 years. And so every year we depreciate how much out of it? 10,000. So did I say 100,000? So every year 20,000, all right, will be depreciated. So at the end of the first year, the net book value will be what? Somebody, 80,000. Does everybody understand why it's 80,000? The cost is 100,000. The useful life is 5 years. What that means, and we are depreciating it at a straight value or straight line, all right? What that means is for each year, we'll depreciate it by 20,000. And we got that 20,000 because we had divided the 100,000 by 5. So each year, 20,000, each year, 20,000, each year, 20,000. Let me finish, then I'll take your question. Each year, 20,000. So at the end of the first year, depreciation of 20,000 will go out. So accumulated depreciation will be 20,000, and the net book value will be what? 80,000. Are we all fine with that? At the end of the second year, another 20,000 will be depreciated. So the accumulated depreciation at the end of the second year will be what? 40,000. Do we understand that? Do we understand that? Who does not understand that? Hand up. Okay. Okay. Can we see? Okay. So the cost of the item is 100,000. The cost won't change. All right? But then, and we say here that the useful life is 5 years. All right? What this means is that each year, 1 out of 5 will go out as depreciation expense. All right? So the cost is 100,000. When you divide 100, all right? So each year will have depreciation expense 20,000, 20,000, 20,000, 20,000, 20,000. This will address your question. Then we have what we call accumulated depreciation. It is accumulated depreciation because we accumulate it at every point. So at the end of the first year, what will be the depreciation expense which would have been accumulated? 20,000, because it's just the first year. It's only one, right? 20,000. At the end of the second year, what will be the accumulated depreciation? 40,000. Do we understand why it is so? So this is the formula. Accumulated depreciation is the previous year's accumulated depreciation plus the current year depreciation expense. So, I say it again. The formula for accumulated depreciation is the previous year's accumulated depreciation plus the current period's depreciation expense. Does that make sense? Good. So here you have this, which is the previous year's accumulated depreciation, plus this, which is the current year depreciation expense. All right? So what will be the accumulated depreciation for year 3? 60,000. We get it. Good. And that for the 4th year, I'm not hearing it loud. 80,000. Who does not get it? Everybody gets it. You don't get it. Okay. So let's fix it. So as I said earlier, you have gone to buy an item. The cost of the item is fixed. It doesn't change over the period that you are going to be using it. However, the value of the item, you are going to be benefiting for that item over a certain period. So the whole concept of depreciation is for you to spread the benefit of that item over the period for which you are going to have benefit for it. You get it? Good. So you have 100,000. And you are saying the useful life, which is the period you are going to have in benefit, is 5 years. So per the straight line method, divide the cost by the number of years. And when you do that, you are going to get 20,000, which means every year you enjoy 20,000 off the 100,000. Does that make sense? You get it to that point. Good. So that's how come we have this depreciation expense. And now we want to know at the end of each year how much of the benefits have we enjoyed so far from whence we started using the assets. And that's what we call accumulated depreciation. You can call it the accumulated enjoyment. All right? All right? So, at the end of the first year, we would have cumulatively enjoyed 20,000. But at the end of the second year, cumulatively, we would have enjoyed 40,000. At the end of the third year, cumulatively, we would have enjoyed what? 60,000. At the end of the fourth year, cumulatively, we would have enjoyed what? 80,000. And at the end of the fifth year, cumulatively, we would have enjoyed what? 100,000. That's it. All right. Great. So we have what we call here the net book value. Well, that's an old term. Currently, per the International Financial Reporting Standards, the proper name of it is carrying value. That's what they call it. But yes, your lecturers rendered it net book value. So you won't be wrong when you say it that way, all right? So net book value here is just telling you that at every point in time, how much more of the enjoyment is left. So this is the full enjoyment, the cost. This one here is enjoyment per period. This one here is enjoyment as at date, that we have benefited as at date. And this one here is saying how much more of the enjoyment is left. Per this understanding, what is going to be the formula for you to get your net book value? And the response I'll get, please microphones, the response I get, I want them in enjoyment terms. So whoever is responding, respond in enjoyment terms. Microphone, please, come to the phone. Yes. Gloria is here, yeah. Gloria wants to respond. Yes. Turn it on, please. Enjoyment terms, yes.
Okay, so you have an accumulated depreciation for the first year
Yeah?
being 20,000,
Uh-huh. Uh-huh.
and the cost is the fixed cost is 100,000.
Mm-hmm.
So you have to subtract what you have already enjoyed, which is the accumulated depreciation, from the the cost of the item, which is the 100,000. So when you subtract the 20 from the 100,000, you're left with 80,000.
Okay. So what you are saying is that the enjoyment left
It's 80,000.
is equal to the total enjoyment available minus the enjoyment consumed up until now. As simple as that. So net book value is the cost less accumulated depreciation. Does it make sense? Good. So here you have first year will be what? 80,000. Second year will be what? 60,000. Third year, 50. Oh, fourth year. Fourth year, 20,000. And then the fifth year, 0. Please, in accounting, if it is 0, use dash. Why? Don't go and write 0. Okay? In accounting. I'm not saying that 80,000 then you write 8 dash 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 dash. I beg you, I didn't say that. I didn't say that. So just if it's 0, then that's where you use that. All right. So you realize something here, and we are doing all of this just because of this. But that would have solved the question of this as well, and the subsequent topics that we don't have to deal with. Good. So what you'd realize is that, and I'm going to introduce a new concept. In the event an asset does not have a scrap value or a residual value, right? A test of how correct your depreciation schedule is that at the end of it, your net book value should be 0. All right? I'll repeat the caveat. And the caveat is if an asset does not have a scrap value or residual value. Scrap value, residual value is the same thing. It's like saying this same car, all right? When we buy it, and at the end of the 5th year, when we are done using it and enjoying it, all right? I'm sure that the rest of it, let's even assume the engine is not working, all right? We can still dispose of it for a certain value, all right? The body, whatever is in it, the hardware, we can sell it for something. That's something we can sell it for. It's what we are calling the residual value or scrap value. Does it make sense? But in the event it is an item that there will be no scrap value for, then always your test of how correct your depreciation schedule is that your net book value should be equal to 0. But if there's a scrap value or residual value, then your last year net book value should be equal to the scrap value or the residual value. Is that clear? So keep that one in mind, all right? You can note it somewhere. So you see this schedule that we've done here. At the end of the 3rd year, what was the net book value? 40,000. We bought it for 100,000 Ghana cedis. At the end of the 3rd year, the net book value of it is 40,000. Meanwhile, that same year, when you go to Tonaton, that same car, my Corolla, I may have bought it for 100,000. But now when you go to Tonaton, after the 3rd year, the same kind of car, having been used for that number of years, the market value of it It's actually 90,000. It tells a certain story that your book value may not necessarily be the same as the market value of the item. Does that make sense? In fact, as at 2015, as of 2015 thereabout, oh, you could get a Toyota Corolla for 35,000 Ghana cedis, home used. Like Ubroni has used it, brought it to Ghana. You could have got it for that value. But today, that same 2009 model Toyota Corolla, right now, you go to Tonaton, that same value is about 110,000 Ghana cedis. You see that? So that market value is what we call the revaluation value. So this revaluation reserve is going to be the accumulation of what we are calling revaluation gains and losses. And how do we calculate that revaluation gain or loss? So it is the revalued amount minus the book value. You get it? So in this case, that at the end of the third year is 40,000. But then the revalued amount is 90,000. What will be the revaluation gain? Please say it out. 50,000, which is 90,000 minus the book value of 40,000. That will be the revaluation gain. That revaluation gain will come and sit in this account as the revaluation reserve. You understand that? So that's how come we keep this account, revaluation reserve. So it could have been that when we did the revaluation, it was actually less, in which case it would have been a loss. It would have come to negate from this account. So that's what a revaluation reserve is. I hope we are fine. I have taught two topics in one upon this one. Then retained earnings. The second statement that we'll be looking at is known as the statement of comprehensive income. And that statement, yes. Microphone, please. We cannot hear.
Hello. Oh, sorry. So the statement of financial position.
Yes.
Like all you've written so far.
Yes.
It's like a formula.
Yes. This one here.
No, I mean the ones preceding
this
that one. Yes.
Okay.
And then the one to your left.
Yes.
It's all a formula you should know.
It's a template you should know.
Before going to.
So let's do this, right? It's important you acquaint yourself with it going into the exam hall. The truth is, it is not that difficult to remember if you follow a certain structure. It is assets, and assets are broken down into non-current and current. Then you have the total assets. Then you come to equity and liabilities. Then you look at equity alone first. Then you look at liabilities. And liabilities is broken down into non-current and current. Then you find a total of liability. And you find a total of liabilities and equity, which should be equal to the total of assets.
Okay. So then it must necessarily reflect each of the narrations you have under the non-current and the current. So let's say...
Yes. So okay. let me, sorry for cutting you.
No, it's fine.
So you have a situation where it depends on the kind of question you even have. Your trial balance would determine what details you would have under each category. And when we went for the break, I was having a little engagement with some of my colleagues here, and it became clear that depending on which industry you are even operating in, there are certain assets or liabilities you won't have. For instance, if you are a bank or a financial institution, you are not into trading. So you are not likely to even have inventory. You get that? You could be a trading company. You are not likely to have investment property. Because most of the time, investment property are for those who are into rental businesses. You get it? But if you have this general knowledge of what some of the typical items under each of the categories are, when you see them on the trial balance, you know where to place them on your financial statement. All right?
Okay, so at some point,
Yeah.
I hope I'm not jumping the gun. At
Okay.
some point, are we going to maybe use a question to try and replicate what you've done?
Yes, please.
Okay, thank you very much.
You're welcome very much. So, now we've dealt with revaluation reserve. All right? So we are fine. Good. So I was talking about retained earnings. People, don't forget this. I won't teach it again, no, when we get to depreciation. This is called straight line method of depreciation. The only variation I may make to it is introduce a scrap value. All right? That's the only variation I may make to it. Okay. So, I was saying the next statement we'll be looking at is called the statement of comprehensive income. And the statement of comprehensive income, it shows your incomes and expenses relating to the period, the financial period, all right? So, that summary of incomes and expenses, the net that you are going to have is what we call what? Profits, all right? Net profits or profits after tax, whatever the case may be. The accumulation of those profits over the years is what will come and sit inside this account, known as retained earnings. All right? Your retained earnings. And it's called retained earnings because you have made those earnings less of expenses, right? And so your profits. And they will come and sit with the company. So it is retained earnings. A further reason why it is retained earnings is because ordinarily, when a company makes profits, what does it pay out to its shareholders? Dividends. So, if it has not paid any portion of its earnings out in dividend, then it means the company has retained those earnings still in the company. And that's why it's called retained earnings. Does that make sense? Does it make sense? Good. So that's retained earnings. In fact, when you read the Companies Act, it says that dividends are supposed to be paid out of what? Out of what? Company and commercial practice for responses. Out of what? You have not read. Out of what? Is it retained earnings? It says out of profits. It says out of profits. And so profits, it didn't say out of profits for the period. It says out of profits. Out of profits. And this here is the accumulation of profits. And so anytime dividends are paid out, and we'll see it in one of the statements, the statement of changes in equity, dividends are paid out of this retained earnings. All right? So that's retained earnings. Now we know retained earnings. Now let's look at our liabilities. Here, under non-current, we see long-term borrowings, we see long-term provisions. I'll talk about long-term borrowings. Chairman, you did here. You are the ones who went for the loan. Or therefore, that's Mr. Alute, right? Yes. So we went for a loan. And the loan is for a 5-year period. The value of the loan is 100,000 Ghana cedis. Per the loan repayment arrangement, there's no interest, right? But at the end of every year, we pay 20,000, right? What that means is, for each year, you have to be paying 20,000. At the end of the period that we are reporting, we are preparing our statement of financial position. 20,000 of the 100,000 will become due within the next what? 12 months. Do we remember that? So, the portion which will become due within the next 12 months, what did we say about time interval? When we're talking about current and non-current liabilities, what did we say? We said that if an obligation falls due within the next 12 months, we call it what? A current liability. But if it falls due beyond 12 months, we call it a non-current liability. So of the 100,000, 20,000 of it will be current liability, so short-term borrowing. And the remaining 80,000 is going to be long-term borrowing. As simple as that. Does it make sense? Good. Now let's look at long-term provision. Yes. I should say that again. Okay. So when it comes to borrowings, in fact, generally, liabilities, the liabilities that fall due within the next 12 months are considered current liabilities because of the concept of time interval, right? So the portion which falls due within the next 12 months is known as current liabilities. But the portions that fall due beyond 12 months will be considered as non-current liabilities. Is that clear? Good. So, in our case, we went for a loan of 100,000. The payment terms are such that at the end of each year, we'll pay 20,000 for a 5-year period. All right? What that means is, as at our reporting date, 20,000 of the 100,000 will fall due within the next 12 months. And so that 20,000 is a current liability. But the portion beyond the 12 months, which is 80,000, that is for the remaining 4 years, will be non-current liabilities. Is it clear? Good. So we would have the short-term one, which is the current one, 20,000 short-term borrowings, and this one will be considered long-term. I hope that's clear for everyone. Okay. Now, it's a similar concept when it comes to provisions, but you need to know what provisions are to start with. So, a provision basically is a present obligation, all right, as a result of a future occurrence for which there is present evidence. I'll take that again. A provision is a present obligation for a future occurrence for which there is present evidence. You should write it out and visualize it. A provision is a present obligation for a future occurrence for which there is present evidence. I'll use an example to illustrate that. You are a lawyer in a company, Your company went into a transaction with a customer, and the transaction required you to perform a certain obligation. There were covenants in there, the breach of which will result in certain damages. And you spelled out those damages, the value of those damages in your contract with that customer. All right? You went ahead and in the execution of your responsibilities under that contract, you breached the covenant. What that means is a loss causing event has occurred. Correct? Are we all aligned? Good. Now your customer has proceeded to take the matter to court. Right? And you are sitting there that, oh, we are waiting for the court to decide before we recognize an obligation. As a lawyer who has studied legal accounting, don't give that advice. Because you are today learning about provisions. And what that scenario tells us about provisions is that you entered into a transaction, right? And spelled out the terms and gave an indication of the damages for a breach. The future occurrence is the court awarding the damages. But there's present evidence. And that present evidence is you having gone into the transaction, spelled out the terms, and actually agreed on the damages in that contract. All right? So although the future occurrence is yet to happen, which is the court awarding those damages, you have present evidence of that obligation that you have. So you need to provide for that obligation. And that's why we define a provision as a present obligation for a future occurrence for which there's present evidence. Does it make sense? Does it make sense? Hey, lawyers, I'm not hearing you. Does it make sense? Okay. I want to hear somebody render what I said. What provisions are? What's the provision? Then I know that we get it. Microphones, please. Anybody? Please come, hurry up. Microphone, yes.
So would an insurance company regard its insured as a provision?
Okay. Fortunately, there's a chartered insurer sitting right behind you. Before I respond, I'll let her. Yes, she's called Sandra. Give it to her. Yes, Sandra. Did you hear the question? His question was, will an insurance company regard its insured as people to make a provision for?
So,
If it's too hard, don't worry, I can answer it, but I want to hear from you.
okay, so typically they would provide for claims of those insured because there's the likelihood during the year that there will be claims that will be made on them as insurers. So you have to provide, it's like you have to estimate and budget for likely claims that are going to arise out of the premiums you are going to be collecting. So you make provisions for claims. I don't know if that answers your question.
It does answer his question, but he's finding it very intriguing. Yes, that's what happens. So it is based on a concept known as And the concept of prudence basically says that you need to be realistic about your earnings and expenses to be incurred. All right? Your incomes to be earned and your expenses to be incurred. And in this case, you realize that an insurance company will typically have history of claims for the various premiums that it collects from clients. So maybe over the period they realize that on an average, claims will constitute about 60% of all premiums collected. All right? What they will do as of the reporting time is to make a provision for claims payments. And so they will compute that 60% of all premiums collected and provide for it as provision for claims payment. They are being prudent in recognizing a present obligation for a future occurrence for which there is present evidence. Does it make sense? Does it make sense? Good. So that's what tends to happen. And so that is what provisions are. And so now that you know provisions, the long-term part is that which is due after a 12-month period. And the short-term part is that which is due within a 12-month period. I hope that is clear. So we are all fine. Good. Payables. Yes. Clinton.
Examples of provisions,
Yeah.
what the discussion has been so far is that insurance claims,
Mhm.
depending on the company,
Yeah.
maybe legal fees if they are involved in a
Legal fees. Yes. Mhm.
then we're also looking at maybe maybe costs involved in transportation of movement. Will that also come under provisions?
Transportation like what?
Sorry. So freight costs, in case you are shipping
Yeah.
anything like that. So that one too, would all of those things be
No,
considered?
but
as
you
provisions?
see, for freight costs, it's in respect of transportation. Has the contract been entered into? You see, and that's what you need to. There must be an underlying transaction. All right? And in the case of insurance, the underlying transaction is having insured the customer by taking a premium. So there's an underlying transaction. In the case of the example I cited, it was that contract between the company and the customer, all right, which had been executed. But if I am projecting that, oh, this year we will ship this number of items, all right, I have not entered into the transaction. So why am I providing for freight? You get it? There must be an underlying and that's why the present evidence is very important. You get it? Good.
Thank you.
You're welcome. Any other? None else. Good. So now, payables, accounts payables. You see how we have receivables here? The same way. You have gone to buy items. All right? These typically are trade items. All right? Payables. So long as you've not paid for it, you need to recognize it as a trade payable. Some of it, we call it accounts payable. Others will call it creditors. All right? So if you see payables, Mr. Remo, it is the same as creditors. If you see receivables, it is the same as what? Debtors. All right? I hope we are fine. Good. And then accruals. Colleagues, accruals are also payables. Just that in the case of accruals, you remember that for payables emanate from what kind of transactions? Say it, yes. Sorry? Goods bought on credit. So it is purchase transactions, right? What did we say was the source document for purchase transactions? purchase invoice. Exactly. But you may find yourself in a situation, so once you have the purchase invoice, you can recognize the payable. But there are certain purchase transactions where you have not received the purchase invoice yet. Does it mean that you are going to sit down and not recognize the liability? No. Based on the prudence concept, once again, you need to accrue for that expense and liability. All right? So let me give a typical example. You're a company whose water service provider is Ghana Water Company Limited. You are ending the month of April. Let's see. You ended the month of March. As of the end of March, all right, 31st March, you are closing your books. They've not brought you your bill. All right? Ghana Water Company Limited has not brought you your bill. Are you going to say you won't record an obligation towards Ghana Water Company Limited? You won't be prudent. So you need to recognize an obligation for that. But how do you do that? Oh, you've realized that over the months, January, your bill was 20,000. February, your bill was 25,000. March, it has not come yet. But when you watch your pattern of consumption, the increase from January to February is pretty much the same increase from February to March. All right. So you just add another 5,000. So you can accrue 30,000 cedis as your water bill for March, while you are waiting to actually receive the bill from Ghana Water Company Limited. Does that make sense? So now you are recognizing an obligation, but it is not based on the actual invoice. So what you have done is to take an estimate of your liability out of prudence. And so we'll call it an accrual. So that is what an accrual is. Does it make sense? Does it make sense? So I have dealt with two topics I won't come back to: prepayment and accruals. All right? And that's how we are going. So you see, we are done with that one. So that's accruals. Of course, we dealt with short-term provisions. And then we'll do the respective summations. And then we are done. That's the statement of financial position. People of God, let me say this. The statement of financial position is the same as the balance sheet. So if you are wondering, when will we get to balance sheet? This is balance sheet. So that's it. All right. So if you go into the question and say, prepare the balance sheet for ABC Company Limited, please, it is the same thing. Don't get confused. Just that balance sheet is a cake name. It is, they used to call it that way. Now we call it this way. All right. That's it. So we are done with this. You'd realize I did something in terms of the columns. I did two columns, all right? The reason we do this is so that we can see clearly some of the summation activities. So the inner columns are more for workings. So you add this. When you get it, you put it here, because you'll be using this later. This one, you add this when you get it here. So we add these two on the line. Yapon. Here, we do this, that we've closed it. Here, we add this, we get this. Then here is this and this. Then we get this, so we double underline. So that's why we present it this way. All right? I hope we are fine. We are fine. Excellent. We'll rush through the other three This is the most troublesome one. The other three are not as troublesome. And the truth is, they won't ask you to prepare all the four. At most, they will make you prepare two, which is this one that we've done and the second one that we are going to do. People, the second one is what is known as statement of comfort. What's the name of it? Comprehensive income. So we mentioned earlier that the statement of comprehensive income it shows the various incomes and then expenses, right? Good. So typically, this is how it will be like. Okay. So this is a statement of comprehensive income. And let me put it out before this one so you get confused. It is the same as the income statement. Okay. Okay. Mamiaba is the same as income statement. Okay. All right. Excellent. So again, in accounting, we don't write negative. The negative, we put it in brackets. All right. So they like to say less, less, This one's what? Add less. Less. It is just extra brothel. If you know what you are doing, you know what you are doing. So now let's walk through this. And again, just to remind us that for the purpose of this course, most of our things is in respect of a trading company. All right? So revenue is the income earned for the sale of goods, right? The core business or core operations of the company or the entity, all right? So revenue here is the income earned from the sale of goods. And I said income earned and not money received because it is not all earnings that we would have necessarily received payments for. All right? You remember we spoke about debtors or receivables. So once we make a sale on credit, we need to recognize it as revenue. And what kind of transaction will give rise to revenue? Sales transaction, exactly. What's going to be the source document? Sorry? Sales invoice. What will be the book of prime entry? Sorry? Fine, book of prime entry. Sales day book or the sales journal. What will be the principal book of accounts? Excellent. You understand. So that is revenue. So it is possible that in this case, we may even have what to adjust the revenue. This one, if you get it correct, extra refreshment. Where do you manasa? Where to us here? Oh, somebody tell me, what transaction can make an adjustment to the revenue? Hey, return inwards. So there's the possibility that you have return inwards to be shown somewhere here, and they will say, let's return inwards. So that when you take that one out, what are you going to have? Sorry? Net sales or net revenue. Yeah, correct. You guys get it. I'm liking it. You get it. Uh-huh. So now we get the whole idea of revenue. We've understood it end to end. We get it. Good. Then we have what we call cost of sales. Other renditions will say cost of goods sold. Right? Cost of goods sold. The cost of goods sold are the direct expenses incurred in respect of making a sale. All right? The direct expenses in respect of making what? A sale. And typically, what will be those kinds of expenses? Think about it. You're a trading company. What will be some of the typical expenses in respect of directly making a sale? Carriage outwards. Carriage inwards. So the cost of bringing the item to the point where you can sell it is part of such expenses. What else? Sorry? What's it saying? What's it drawings? They were like made draw table and so on and so on. when I take some of the goods for personal use, okay, okay. Why is that relevant for this? I'm just asking. Okay, so that may not necessarily, because that will be an adjustment between your inventory and the proprietor's account. All right, but that won't come here. Hey, you people, the most primary element you've not mentioned, the stock itself. The stock itself. All right, and how do you get the stock? Sorry? Sorry? I agree, it's through suppliers. I agree. But you see, the stock is a positional concept, which is at a point in time. So we have opening stock and we have closing stock. But what transaction leads to you having the stock? A purchase. All right? So, in the calculation of what your cost of sales is, there is a formula. Please, when you see inventory, it's the same as stock. Okay? Inventory, stock, same. Right? So opening inventory, this is the balance you had at the beginning of the period. All right? And then you made purchases. So you come and add purchases. All right? We get it? What was the other item you mentioned? Sorry? Carriage inwards. So the expense when it comes to the carriage inwards. And then what else? You say you don't know, so I should just go ahead. Okay. So she made a very important point about drawings. You see, the drawings made by the proprietor for self-use should not be considered as part of the cost or the expenses of the business. Because what this formula is going to do is to ultimately record an expense relating to the period. All right? All right? So we may have bought items as part of purchases, but a portion of it was taken by the proprietor. We need to take it out. We can't consider it as part of our expenses. All right? So this is added, but this is taken out. And please be careful. The drawings, they could be cash related or they could be goods related. When they are cash related, I beg you, don't bring it here. It's just for the goods. All right? And then finally, you also take out the closing inventory. So this is plus, plus, minus, minus. And this will give you your costs of sales. All right? Yes. Okay. Thank you for the question. So there are ways of presenting. There's a way to present your statement to make it very cluttered. And there's a way you can present your statement to make it decluttered. So one of the things that those who are interested in having it very decluttered will do is they will have a whole page and put the caption workings. Number one, cost of sales. Then they will do their workings. When they get the answer, they just come and put it here. All right? For other people, say, oh, media, I don't want to miss anything. I just want to do it whichever way. So they will now come and do all of this here. Before you know, your statement page is doing first page, second page, then you get it. So based on the things you prioritize in life, if you have OCD like I do, you probably do this and then come and do this. But if clutter doesn't disturb you, you can come and do the full details here. So that's that. Cost of sales. Then we have gross profits. And then we have here selling, distribution, and administrative. Yes, you have another question. Yes.
Please, what of you did purchase
Yes.
and then you realize some of the goods are not fit for purpose and you return those goods back? How would that be treated?
Thank you for bringing that up. So you realize how we spoke about return inwards. There's the possibility you can have returns outwards here. So it will work in the reverse of the purchases. So return outwards will come in as a negative here as well. All right. Thank you for bringing my attention to that. We can introduce it. It's not always that you have it, but yes, better have it in mind. So this is less returns outward, and that will go in as a takeout. Charlie, what's your accounting? What's your accounting? Yes. So that's that. I hope this is clear. We're good. Everybody's fine. Excellent. So now, we have selling, distribution, and administrative expenses. Selling, distribution, and administrative expenses is every other expense as far as operations are concerned. Operations. And so, it could include rent, rates, insurance, depreciation expense, amortization expense. Depreciation is in respect of what assets? Fixed assets. What is the another name for fixed assets? Minimum you're fine. What's another name for fixed assets? PP, property, plant, and equipment. Okay. Amortization is in respect of what assets? Intangible assets. Good. So that's that. All of those expenses sit under selling, distribution, and administrative expenses. This one you cannot forget though. You know why? It's SDA. Selling, distribution, and administrative expense. SDA. All right. So all of those other expenses in respect of operations, aside from direct sales expenses. So here, carriage outwards will be part of this. It's a distribution expense. You get it? Marketing expenses. All of them, they will be part of this. Rent, rates, all of those things. They will be part of this. All right? And then this will give you what we call net profits, operating profits, or profit before interest and tax, PBIT. And there's a science to this. You realize that you have your revenue. When you take out the direct expenses incurred to earn the revenue, what you get, you call it gross profit. It is the profit before I consider other expenses. All right? Because so far the only expense I've considered is the direct expense, all right? So the gross profit, now I need to consider the SDA expenses, all other operating expenses. So once I've considered all the other operating expenses, then now what do I have? The operating profits, because it's profit directly from operations. And that's why it's called operating profit, or net profit, or profit before interest and tax. What this tells you, this profit before interest and tax tells you, is that for the next level, you are supposed to be considering interests and tax. So after here, we come and consider interest. As a business, you may earn interest income. It is not your operating income. As a trading company, interest income is not your operating income. So maybe you have earned interest on your bank balances. All right? That's interest income. So that one will come here. But you may also have incurred interest expenses on, say, a loan that you took. All right? So that will come in as interest expense. So whereas you'll be adding interest income, you'll be subtracting interest expense. Does that make sense? Do we all get that? Beautiful. So once you take out interest expense, add interest income, what will be left? Now you've dealt with interest. So it is what? Profit before tax. So tax is the only thing I'm yet to consider now. Is that clear? Are we good? Good. So now I consider income tax. This was profit before tax. Now that I've taken tax out, what is it? Profit after tax. Have we not finished? You have a question? Yes, please. Microphone for comfort. Yes, quick.
What about dividend for?
Okay. So she's asking, what about dividend for preference shareholders? Dividend for preference shareholders. Who know? In fact, you now tell us what are preference shareholders? Oh, I'm not asking why you are asking. I'm asking what is preference shareholders. Yes. Okay. Okay, good. So let me just explain it. And she's not wrong. So preference shareholders, every time you see preference shares, there's a percentage to it. So they'll say 5% preference shares holders, 10% preference shareholders. The substance of preference shareholding is a loan. All right? The substance of a preference shareholding is a loan. And for them, at the end of every year, they earn a certain, in quotes, interest on their shares. You see, ordinary shareholders, when we looked at statement of financial position, their thing there was what? Stated capital or share capital, right? Preference shareholders, on the statement of financial position, ordinarily, they will be part of non-current liabilities and not part of even equity. Preference shares. So the substance of preference shares is a loan. So once there's a loan, you are likely to have an interest expense. So mostly we tend to put them as part of interest expense. But for distinguishing sake, if you go and you have a question which says preference share interest or preference share dividend, you come and add it to this one. You can put it as a line under interest expense, and that one too will be a negative before you get your profit before tax. All right? Is that clear? So it is an interest expense you would have incurred. All right. So that will be one of those expenses as well. I hope we are fine. Great. Awesome. Any other question on here? So today we'll close in a few minutes. We will have to have another session. Yes. So we'll have to have, yes, please. Please, mic for him here. Yeah.
Okay, so with this part, I don't really get it.
You don't get it?
Yes.
Okay.
It's like the information is a lot.
I get it.
So if I'm not taking the class back, I think that you should take your time to explain from the revenue. And also I want to you to help me appreciate the difference between what a revenue is and what an income is and the profit is. The three, I want to know the distinction among these three, and also the calculation you did for sale. Also, I want you to take your time to break it down for us to really appreciate. I think this part, you must really take your time to, so that we don't come back again to this.
Okay. Okay. Aside from him, who has a challenge with what we've done so far? Let me see the hands. 1, 2, 3, 4, 5. Okay. So, this statement, the statement of financial position tells you of your position at a point in time, which is the previous one we looked at. This statement of comprehensive income, also known as the income statement, tells of your performance for the period. Your performance for the period. All right? So the ultimate objective is to know whether you made a profit or you made a loss. That's the ultimate objective. All right? But then, instead of just cramming all incomes together and cramming all expenses together, we are saying let's have a certain structure to it. Let's look at the operating element first. And for an operating entity, the primary incomes and expenses when it comes to your operations. So on the income side, you would have revenue. You call them sales as well, or turnover. All of the three, in the case of a trading entity, will have a similar thing, all right? And then you look at the expenses directly incidental to you earning that revenue or making that sale, all right? That's what we are calling cost of goods sold or cost of sales, all right? So after you consider that direct expense associated with the revenue, what you have is what we are calling gross profit. Is it clear to this point? Is it clear to this point? Good. So now that you have your gross profit, now consider all the other operating expenses which are not directly associated with you making a sale. And so you would consider something like distribution expenses, marketing expenses, salaries, wages that you pay to people, all right? Your staff, like somebody sitting in finance department, somebody sitting in HR. Their expenses are not directly incidental to you making a sale. Is that clear? All of those expenses, your rent, your bills, your light bill, insurance expense, we spoke about depreciation, we spoke about amortization. All of those expenses will make up your selling, distribution, and administrative expenses, all right? So once you've been able to consider all the other operating expenses and you take them out of your gross profit, now you would have what? Your net profit. And it is also called operating profit because it is the profit from operations directly, which is your core business. All right? So once you have that, and it's also called profit before interest and tax, that should tell you that beyond your operations, you may have financing matters. And it's a financing matter because interest, interest expense is as a result of you seeking finance. So the interest on a loan, all right? So that is an interest expense. Interest income, like we were saying, your bank account has earned a certain interest on it. That is not your core business. To keep money in accounts to earn interest. You get it? So it is not part of your core operating items, operating activities. And that's why it is not above the line. It is below this line. You get it? Good. So that's how come we have these two here. Of course, you add the income, you take out the expense, all right? And so once you do that, you have dealt with the interest element. So now you have profit before tax. So maybe if this will help, PBT. So you had PBIT, the I has been dealt with here, so you are left with PBT. All right? And then beyond your financing, you have statutory payments, which is what we are calling taxes. All right? And so your income tax for the period will also be deducted from this. Then you would have your profit after tax. I hope this structure makes sense to this point. Good. Now, let me deal with your question of the difference between or among income, revenue, and profit. That was the question, right? So, incomes are the various flows that come to the business as a result of transactions that it engages in, all right? Some of them may be coming to the business as a result of its core business, all right? As a trading company, if your core business is to sell goods, all right, then whatever income you make in respect of selling the goods, it will be called revenue or sales or turnover. They mean the same thing. So if your income is in respect of your core business, then it's called revenue or sales or turnover. All right? But if it is not directly in connection with your core business, that's why you have names like interest income here. So income is the umbrella name. Revenue is a type of income. Does it make sense? Does it make sense? Okay. So I'm saying that income is the economic flows that comes into the entity, right? The various economic flows that come into the entity. That is what we call income. Break the word down. Income. It comes in, all right? But then, specific to incomes that arise from your core business operation, we call it revenue. And that's why we have this. Then now, so what that means is income is the umbrella name for all flows into the business. But revenue is a type of income. So you'll be correct when you say revenue is a subset of incomes. Because there are other incomes like this. Interest income. All right? Good. So, those are the two. Now the question of profit. Profit is a function of incomes and expenses. So when you consider income and expense, the resulting item is what we call profit. Does it make sense? Does it make sense? Does it make sense to you? Does it make sense to you? Jasmine, does it make sense to you? Okay, let me take it again. So for you to know what profit is, necessarily there has to be the presence of both income and expenses for the period. So when you take out your expenses from your incomes, that's how you get profit. And so look here. You realize that for us to get gross profit, we had to take out cost of sales, which is an expense from revenue, to get this profit. Even while here, we still had to take out these expenses to get this type of profit. And still here, we had to still consider income and expense to get this kind of profit. And even tax, which is a tax expense, we had to take it out of this to get profit. So know this, profits are a function of incomes and expenses. Revenue is a type of income, and incomes are the flows that come into the business. Addressed? Yes.
I want to find out whether does it get any complex than this, because
Does it get any more complex than
yes,
this?
because right now this is what we have in our mind.
Yeah.
I mean, this is what I have in my mind.
Yes.
But can it be that we're going to the exams hall, for example,
Yeah.
and then we see other elements
Yes.
which are supposed to be, let's say, for example, under income tax, they will give you income tax, and they will give you other kinds of tax obligations that the company is supposed to pay. Or maybe, and let's say, calculating the revenue or finding your revenue, they'll give you other elements which they expect that you should know that would go into you computing your revenue. Does it get more complex than that?
Yes. It can get more complex. In fact, beyond you being in this school and writing that exams, in real life, it can even get very complicated. All right. So, but for the purposes of, the learning, this is what we are doing. We are starting from the known to the unknown. All right. So we are building on the knowledge. When we get the opportunity to actually use a question to run through it, you get to see how this plays out. All right. So that's the whole point. For something like, and I'm happy you speak about revenue. So he had spoken about the cost of sales. And you see, cost of sales is this detailed to get this single line. All right. Revenue too. So we spoke about, so you would have, say, gross revenue. All right. All right. And then you may have returns inwards. All right. You could even have here discounts allowed, because per your original pricing there was no discount here, and they returned some of the items, and you even told them that if they pay by a certain time you give them a certain discount. So you also have even discount allowed here. All right, before you can get your net revenue. So you may start this way. You take out this, you take out this, before you have this item, which will come here. All right. Similarly, here you have this. In fact, here we can introduce another line. Which line is that? Looking here, what else can we introduce here? Sorry? Discount received. Do you see it? Oh, you don't? So there's discount allowed. There's discount allowed when you are making a sale. So you are the one allowing the discount. You have your fixed price, but you tell them that, oh, if you pay by this time, I'll give you this amount of discount. All right? Similarly, when you are making a purchase, right? When you are making the purchase, you could find yourself at a place where they will tell you that, okay, you too, if you make a payment by this time, we'll give you this much of discount. that element needs to be taken out as well. Because your purchases, you probably would have valued it at the full amount. But if you receive a discount, you need to take it out as well. All right? Does it make sense? Good. So here. Yes, Peggy. Where do you take it out from? So it's here. You would have had this here, discount allowed. So you made a sale, 10,000 Ghana cedis. That's the value.
So
5
you have,
units
the discount received, you are taking it out from the
purchases.
1 year. So the discount allowed, which one am I taking it out from?
Sorry, say that again. Uh-huh.
The discount received, see all those things up there, they make the cost of sales, right?
Yes.
So the
Oh, this.
uh-huh.
What does it do?
Yeah,
It gives you this net revenue.
that's where you find the
That's where you do all of this.
return inwards and all those things.
Yes. To give you this net revenue.
Okay.
You get it? So this is to help you compute this. This is to help you compute this. Are we fine? Yes.
Senior, thank you very much. I have a little suggestion and a question.
Okay.
Maybe next time you clean so that you write legibly, they will see the stuff that you've written there.
Okay.
The next one is, I realize that you are teaching some of the subjects whilst doing this.
Yes.
Like the concept. I've heard of 2 concepts.
Yes.
The time interval,
Yes.
which you said it relates to issues that has to do with a year, within the year.
Yes.
I didn't get that of the prudence very well. So please, if you can explain that to me.
Okay.
Thank
So
you.
the prudence concept basically says you should be realistic in the recognition of your incomes and expenses, as well as your assets and liabilities. And that concept is somewhat connected to the concept of accrual, right? Recognize a transaction when it occurs and not when payment is made in respect of it, all right? And so that's why we had the accrual concept. And prudence says be realistic about your earnings and your expenses. And I'll give you a typical example. Okay, so accruals is recognize transactions when they occur and not when payments are made or received in respect of them. All right? And still on the prudence, you realize that when we spoke about provisions, although we have not received a court order or a court award for us to make a payment to the customer, by virtue of the knowledge we have and the evidence we have already provided for that liability. And that's you being prudent, taking cognizance of what is practicable. Similarly, when we deal with provision for bad debts, you have made a sale. So you have recognized revenue and you recognize receivable as well. All right? But that receivable, will you be able to recover the full amount? For instance, one of your customers his company has been liquidated. When is he going to pay that money? The person won't pay the money. So you need to make a provision for bad debts for it, or even write it off as a bad debt. All right? And you also know that maybe for certain types of customers in certain kind of industries, they have a history of not paying a certain percentage of their debts. So once you have that, you need to make a provision for that. And all of that is part of the prudence concept. I hope it's clear. Great. There are a few others. There are about 10 other concepts. In total, 13 for the purpose of this course. But yes, that should be, I will deal with that. Are we fine to this point? We are all fine to this point. I think there's been a lot of information shared today. We need to go and rest our minds. We need to go and allow it to seep in. God willing, we'll announce another time to continue. And when we do that, we'll get the benefit of solving a lot more questions based on what we've done up until now, because we needed the foundations to be able to deal with that. What I see we will need is another session to complete the rest of the topics, and then another session to just solve questions. And this is how we are going to do it. Each one of us, let's go to the YouTube channel, Make It Count with Benji, and subscribe, all right? God willing, this week, elections are going to happen. Once elections are done, Benji will be significantly freed to have a lot more of the episodes uploaded, all right? So, per our plans, before the middle of May, we should be done with pretty much all the episodes online. Let's spend time there, because that one, it's even broken down further, and that one, at your own luxury, let's cover all of those. The next time we come, you have a lot of knowledge to make it move faster, and then we'll spend some time also solving questions. I hope that is fine. I hope this session has been helpful. Good. And final thing. Oh, last but one thing rather. Let me do a little politics. Benji is running for president. Benji is number 2 on the ballot. You've engaged with Benji a number of times. I am saying vote for Benji for president. And that's small summary. And then the very final thing. Thank you for showing up. The ultimate objective of these things that we are doing is to ensure that nobody, as much as possible, who passes through this school should struggle with legal accounting. It is my personal objective that at least 95% of us will pass legal accounting and LPM. So you have come to the class, but legal accounting, it is not just listening and watching. It takes practice. Please, when you go back, practice. I beg you. We started with a prayer. Anybody to pray with us so we can close? Anybody to pray so we can close? Anyone? Okay. Please pray with us so we close.
Please, we are praying. Our Heavenly Father, we thank you so much for such a wonderful discussion. We thank you so much for everything that we've heard and everything we have learned and studied. It's our prayer that even as we go back, you help us to be able to put all that we have learned into practice. We also bless you for the life of our teacher, and we ask that, oh Lord, even as we go to the polls, you will let your will be done in his life. In Jesus' name we have prayed. Amen.
All right. I don't know why they turned off my mic, but that's okay. Guys, thank you so much. Yes, okay, all right. So, colleagues, we are settling down, right? So, if you can assist with probably getting some of the things downstairs, we'll be very grateful. All the best.
Okay.